Hey, good morning, everybody. It's Hammer. Let me adjust that camera. There we go. How y'all doing? It's Monday, January 26, 2026. Sorry if I'm making you dizzy. I'm trying to get it just right. There we go. We'll make that count. So, hello. Welcome, everybody. I, of course, am Hammer, founder of Originator Success, Grab and Go Social, and Rate Sensei. 3 products to help you to build your brand online, generate reviews, stay in touch with past clients and agents, generate some business there. Grab and Go Social is all about posting on social for business, giving you content as well as coaching and community. And Rate Sensei is all of our rate stuff, like what you're on now and our $7 text alerts, home of the $7 text alerts. So welcome, everybody. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. Broadcasted to you on Facebook and on YouTube. Today, we're going to be talking about the rate outlook for the week, what we think is going to happen with rates this week, and even as we head into next week. Of course, that's going to include a countdown to the Fed meeting, and we'll be talking about Japan's borrowing problem and what role that's playing in our bonds and therefore our rates. So I will throw that up on the bottom. Remember, you could sign up for a reminder text message that I'm going live. If you don't want to miss the show, you can absolutely get a quick text message with the link so that you can log right on. hmmr.io/reminder, or use this cool QR code over here on the screen. It's hmmr.io/reminder. Also, while you're out there, don't forget, sign up for our free daily email lock advice at www.ratelockadvice.com. Get a free email to your inbox each and every weekday morning. Use it as you see fit. On Friday, I asked some of our members, subscribers, what they thought of it, and got a lot of great feedback. Thank you. And got some feedback that I can incorporate to make it better. So appreciate that. Thank you so much for that. Also, don't forget, although the live is free and our daily email is free, the one paid thing that we have right now at Rate Sensei is our rate text alerts. They're $7 a month, and they'll keep you protecting your pipeline. Go check them out at ratetextalerts.com and sign up for those and definitely do better. So anyway, if you're here this morning, say good morning. Let's go ahead and say hi to all the live folks here this morning, all of my friends. And then we will jump in and get started. We got about 30 of you on this morning. Oh, it's funny. Badita said he couldn't hear anything and then said he lied. It was muted. I was like, anyone else having problems? Mallory Fodiatis, good morning. Faye Escribano and Angela Walters, good morning. Allison Foy, Christy Mew, Mike Brown, Michael Garcia. Great to have all of you here. Loans with Mo. Did you spit out that kid yet? Let me know, Ms. Mo. Loans with Mo. I can't tell, the picture is too small, but that's got to no. Oh, that's why it's a different Mo. There's another one with Mo, who is in Tennessee. Morgan Fleet, or actually Fleet was her pre-married name, her maiden name. So Morgan, don't know her last name anymore. That's what the Mo I thought it was. So sorry, it's because they're very small, so I can't see. Ron Seco says, good morning. For those who've beaten anorexia, today we celebrate National Peanut Butter Brittle Day. We also celebrate National Spouses Day. National Spouses Day, 38 years. Ron's been married 38 years. Can anyone beat that? I got 28 years. This will be my 29th year. So let me know in the comments. All right, let's go ahead and let's get started. We'll get to the good stuff here, and bear with me a minute. All right, so we'll start out by taking a look at the technicals here, and start out here with the technicals. We can see that mortgage bonds currently up a whopping basis point or two here. You see it right here. We're up about 1 basis point on the day. Quick recap of what happened yesterday. On Friday, that's everything. It's down here in this lower corner. And let me zoom in on that so we can. All right, there you go. So I got to make this fit on the. Hold on a minute. Sorry, y'all. I thought that would fix it, but I can't scroll anymore. And I can't grab the corner. Nope. Come on, get rid of that. That's what I want to do. And now move this up. Okay. There we go. We'll get it. We'll get it yet. I guess that's it. That's about as close as it's getting. So anyway, take a look here on Friday. Everything in front of this dotted line right here. Everything over here. We had some ups and downs. You could see there were, some valleys and peaks over here as things popped up and popped down. But the moves weren't really enough to trigger any reprices. We did end the day slightly better, right around 99.95, just a little bit better than when pricing generally came out. 10 a.m., which would have been right about here. So, it was just a little bit better, but not much. Today, a little bit higher here, as you can see. So that puts us in a position where today pricing should be a little bit better than Friday, at least similar. So on Friday, you could see that bonds really were kind of stagnating 6.21, 6.20, 6.19. After bouncing up from the low levels, you can see it here in bonds. Over here, we can see it on the 48-hour chart that we had these two green days were the days after Trump's announcement / social post about buying 200 billion in mortgage-backed securities. We warned even back then, I warned that it probably wasn't going to be long-lived, and we didn't know how long it would live. Didn't expect it to get quite so smacked in the head like it did, but it definitely stopped improving. We saw it stop improving that following week. It was down and then up and then down, and but that's where rates kind of just we're at that 6.07, 604, 607. So after hitting their lowest right here on Monday, following post Trump's post / announcement, then they were up a little bit, and then we got the Japanese bond sell-off and Greenland in the same week. Now, it's important to note both of those things had a big effect on our rates of pricing. Absolutely. It's why we saw the initial reaction. It's why things kind of settled in. So we saw that jump, and then now that's where bonds have stayed. And we've seen that here. When we take a look at mortgage-backed securities, you could see that they were down, here we were at 99.72. We've bounced back about 25 basis points to 99.96. So you've seen some of that improvement on rate sheets, but because of the volatility, you're not seeing it as clearly. Oh, I'm sorry, you guys aren't seeing this. Let me pull this side over. You're seeing the middle column. Let me pull that over. There you go. Hold on, I'll get that. All right. So you're not seeing quite as much as here. So as far as today goes, reprice risk on the day is low. Bonds starting the day off with just a little bit of gains. We're up a couple of basis points here. Take a look at the 10-year treasury yield, 4.22, still above the 4.20 mark. That's our new normal here. It would be nice to see below that. Remember, 4.20, that was a big deal for a long time right here, and we're still above that. All right. So we would really like to see if the 10-year treasury yield were to fall below 4.20, that would signal some good things to happen. But right now it's up above. The good thing is the spreads between what we're seeing on mortgage rate sheets and what we're seeing on the 10-year treasury yield had improved after a large part of that was here due to the posts, and still a little bit improved. So we're still, even though the 10-year is worse, we're seeing rates that are a little bit better. So as far as this week's calendar, going to be a lot. Siegel says, what's influencing the 10-year treasury? Hypothesis floating, China selling 10-year treasuries and buying gold. That's a great, hold on, let me pull this up so you can see there. That could be a great argument. Explains both movements, because what he's talking about, part of that is when we look at the price of gold's hit, I think, 5,000 an ounce, which is insane. And that's showing like the true safe haven. Gold surges above 5,000 for the first time. You can see that here. And according to, if we were to argue about what Ron is saying about what's pushing gold to new heights, according to the Wall Street Journal, buying the precious metal has become the antidote for market jitters. We used to see bonds benefit with a flight to safety, safe haven. Not nearly as much as we were though. Lower interest rates reduce the appeal of government bonds, making gold more attractive as it offers greater upside potential despite no yield. So that's what we're seeing right now, where traders are moving to the safety of gold, driving gold to a crazy amount. Let me get rid of the. Look at this. I mean, since 2020, gold was down at normal prices, 1,500 an ounce. Even during COVID, and after that, it was up under 2,000. Look at this. It's insane the way. And what that shows is that people aren't, countries, corporations, they're not investing in bonds and the markets the way that they were, especially for safe havens. They're moving to metals. So that is where things are at. Definitely a crazy part of that. So, but taking a look as far as what else is affecting rates and pricing this week, let me make this smaller and let's see if I can't. There we go. Make it small enough and I will get you the economic calendar. And let's take a look at that together and we'll zoom in back in on this a little bit. And we'll move this for the week. So this week, the economic calendar. Today, we've got durable goods stuff that came in this morning. Was really not a big market mover at all. Wouldn't expect it to be. Tomorrow, you have the new, I say new, it's been a few months now, the ADP employment change weekly that's coming in. It's similar to like jobless claims. We've got on Wednesday, of course, the big event, which is the Fed meeting. So we'll talk about that in a little bit more detail in a moment. How much time we got? 12:20. All right. So, and then Thursday, jobless claims, a big deal. Friday, we've got producer price, wholesale inflation, which is kind of an odd, it's very far after the CPI. Usually the consumer price index, it usually falls in, within a day or two of that. So it's kind of odd to see it this far out, but I don't think we're going to have to worry about seeing much reaction to wholesale inflation, but there is possible. Fed Bowman, keep an eye on that one. We'll come back to her. So we've got the Fed meeting coming up on Wednesday. That is the end of the meeting. There is 0% expectation that we're going to see a rate cut. Markets pricing in no chance at all here of a Fed rate cut. Once again, I'll reiterate, as far as the outlook goes, nobody's expecting to see a cut until Powell is out of office. So for the March meeting, 85% expectation that rates will remain the same. The April meeting, still about a 72% expectation that rates will stay the same. It's not until June that you actually see less than a 50% expectation that rates will stay the same. So there's a lot of argument about all of this. So hold on, let me get to here. So the Fed meeting that's coming up on Wednesday, and we'll spend some more time as we roll into this, but it's likely, as the headline says, to be overshadowed by threats to the independence than actual rate cuts or policy. So I think you're going to hear a lot of drama, threats against Powell, the Department of Justice, situation, inquiry, witch hunt. Lisa Cook, which I also think is a witch hunt, whether she filled out the right thing on a 1003 or not. Just all of this is Trump trying to take control of the Fed. And markets are concerned about that. We've seen that kind of shown in trading as well as in different vocal members of different companies coming out and saying so. There's a lot of concern about, if Trump is able to grab more control. And I mean, an example of him already having control is Mickey Bowman. Mickey Bowman, she was I want to say upgraded, but she was promoted to Federal Reserve Vice Chair for Supervision over banks. And she's implementing a lot of changes to ease the regulatory burdens on banks. And she's facing internal resistance from other Fed members because a lot of these were put into place after 2008 when the too big to fail banks failed. They had to be bailed out and all the bailouts. You remember everything there. Bowman aims to reduce the supervision division staff by 30% with voluntary buyout packages. New guidelines are expected to limit examiners' ability to cite banks for problems to allow banks to contest findings more easily. I'm not a big fan of this personally. I think Mickey is doing the wrong thing here. What do you guys think? Let me know in the comments. I'm not a big fan here of cutting oversight to the banks. Banks are greedy. corporate overlords. There are a handful of them that own everything, and their sole thing is making money. And it's not personal, but I think they need to be very regulated. I think they have a lot that they can screw things up and do things. So, good morning, Mike Tebow. Glad to see you there in Florida, my friend. Although, how cold is it in Florida? I haven't even checked. We had a little bit of snow and some stuff here, but I didn't have Snowmageddon they were talking about. I'm going to come back and read this new tax rules to get you a bigger refund this year. I was just going to curious what they said on there. Other things. Again, we've talked about the price of gold. We talked about the Fed and the different things going on there. So, the last one I wanted to touch on was the Japan borrowing. So, part of what drove rates up last week is Japan had a bond market, sell-off, major sell-off. They're calling it a crash here. But basically it's because the Prime Minister Takachi is looking to spend a lot more money and do some fiscal stimulus. Is it fiscal stimulus or monetary? No, that's fiscal when they do it, right? I always fiscal versus monetary. Fiscal is government. Yeah, that's what I thought. And monetary is the central bank. So if the government is going to do all of these things like cut taxes and all that kind of stuff, they have to come up with the money somewhere, so they need to borrow. A lot of Japan's market is afraid of higher borrowing, in their economy already. It would swell government debt, which is already uncomfortably large. As a result, investors have been frantically selling bonds to a level once unthinkable, more than 4% on the longest dated Japanese banks. That's exerting upward pressure on interest rates from the U.S. to Britain to Germany. I don't know what JGB's it's Japan's bonds. Traders are braced for more disorderly market swings as Japan hurdles towards a February 8th snap election, for which both Takachi and her rivals have campaigned on looser budgets. An even bigger worry for global markets over the long term is that new normal of higher Japanese yields will prompt domestic investors to bring much more of their money back home. Remember, they're investing in U.S. bonds, even with a currency exchange difference and everything else, because of a better return. If the bond yields in Japan continue to rise, they'll reinvest that money in Japan, which means selling treasuries, selling mortgage-backed securities. That's bad for our bond market. Part of the reason we've seen what we've seen and the negative that we get with that. So that's part of what we have going on with our market, was some reaction to that. Not nearly as bad as what's going on in Japan, but it's part of it there. So all of that has pushed rates up, and today you should see slightly better pricing, but overall this week, we'll see what Wednesday brings. Let me throw the lock advice on the bottom. So I would be going ahead and locking anything that's closing in the next couple of weeks. Next week, we've got labor market data. This week, we've got the Fed. I don't see enough chance that rates improve to make it worth floating. I think we could see things worsen from here. So I would be locking anything that's closing in the next couple of weeks because you can't afford the volatility and what could come with it. Loans that are risk averse closing in the middle through the middle or even the end of February now, because we're almost at that time. They may want to consider locking just for protection, but it's unlikely that we're going to see rates move up much higher from here. And then even if they do move up, it'll be an eighth or so, and then it probably come back down. But it's also unlikely that rates are going to improve much from here. Let's see. Ron said, look at reduced bank oversight. Does anyone remember 2008? Exactly. That's what I'm talking about, man. Hi, Natalie. Fallback from New Mexico. Just look at Community Reinvestment Act 1977. Only Clinton enforced and Glass-Steagall Act of 1993, the true causes of the 2008 great financial crisis. I agree with you, my friends. I absolutely agree. And that's why I would not be looking for anything like that. I am going to show you guys, look at my winter wonderland this morning. It's not nearly so bad. Don't worry, I'm going to get rid of my face in a second. There you go. We did not get Snowmageddon here in my little section of love, but we did get a lot of trees down. Look at that tree snapped in half and taking out power lines. And here we had 60-mile-an-hour winds, almost just a hair below 60 miles an hour, 50-mile-an-hour gust winds holding over 20 miles an hour. Crazy, crazy winds for sure. Look at this one. This was me from leaving my son's house. It just blew the trees. It blows them right out of the ground. Their roots just rip, which is, you have to realize how freaking crazy that is, especially for a tree that doesn't have a lot of leaves on it. Just blows them right out of the ground. More trees falling, and it's partly because the ground is so saturated and the wind. So combination of saturated ground and wind causes that. And that's what we had more of here in Western North Carolina. We had some ice, but we did have a lot of winds in that. So Ron Siegel, that's low, man. $4.25 for gas. That's cheap for you guys. We're at like $2.65 here in North Carolina, my neck of the woods at least. So, all right, my friends, I'm going to wrap it up. Thank you for joining me. Appreciate you being here. I will see you tomorrow and have a great day. Take care, everybody. Bye-bye.